We're going to go over asset turnover and return on equity, two of the ratios in financial statement analysis. Asset turnover is net sales over average total assets. So let's go get these for General Mills. At the top of the income statement, we can get net sales. From the balance sheet, we can get total assets. To average it, we take this year and last year, add it together and divide by 2. Then we're ready to compete, and we get 0.8186614 turns, so less than 1 turn. So what is that helpful for knowing? Asset turns is a measure of activity. It tells you how many sales you're able to generate with your asset base. Are your assets being productive? There's no threshold amount, but the higher the number, the more turns, the faster you're going. So near 3 is really amazing, like Costco, and under 1 is pretty slow. So General Mills here has a pretty low asset turnover. What about return on equity? That's net income over either average total equity or average total common equity. Typically, you would leave out any preferred shares if they happen to have any preferred shares. So let's compute it for General Mills. At the bottom of their income statement, we can get their net income. We can go to their balance sheet and look to the bottom and get last year and this year's total equity, add it together and divide by 2 to get the average total equity. Notice we don't have any preferred shares here, so this is the same thing as average total common equity. So we compute net income over average total equity and we get 29.34%. That sounds like a pretty good return, doesn't it? Especially in days when you can only earn maybe 3 or 4% on bonds and maybe not even that much more in the stock market. 29% looks pretty good. Let's see how they compare to Kellogg's, which has been the competitor we've been using. Just as a reminder, return on equity is a measure of returns to the common shareholders, and it's considered a strong overall profitability measure. It should always exceed the cost of capital, and it is used as a benchmark to compare with other investment alternatives. So from the shareholder's point of view, they can own this stock or another one, which one's giving them the better return on their equity. So let's go to Yahoo and look up Kellogg under the finance section, and we see that their return on equity is 59 and a very impressive 60% return. So they are quite a bit more profitable in terms of from the owner's point of view than Kellogg's.